Hello, welcome back to part two of our discussion of, our introduction, you might say, to managerial accounting. We're going to dive into some of the terminology that we're going to use over and over and over again for the next 7 weeks. And remember that none of this is established by particular rules. So these are basically how things generally work. So first of all, we want to identify costs. The whole point of an awful lot of managerial accounting is determining what it costs, because that drives so many decisions that we're going to make. What we need to sell that product for is going to be an awful lot of it based on what it costs. How much profit we're making depends on how much it costs. And so if we're going to determine that, we have to break the costs down into, you might say, categories, so that we use the terminology to help inform our decisions and look at the various pieces of that cost it takes. So if you're just trying to imagine, if you're trying to answer the question, what does it cost to make cookies? A cookie. That's not a simple question to answer. All right, and so that's what we're trying to do. And so to do that, we're going to try to look at the various pieces. So first of all, there are what we refer to as product or manufacturing costs. And we use those terms interchangeably, product costs or manufacturing costs. Those are the costs that are actually necessary to make the product. So if you were not making cookies, you would not have to have that cost. So first, we break that down further, because that big pile of costs is hard to manage. Direct materials is the things that you can easily trace to the cookies. You can actually see them, like chocolate chips in chocolate chip cookies. That's a direct material. They can be bicycle wheels to manufacture bicycle. That's a direct material. Fabric to make a shirt or pants or whatever is a direct material. Direct labor is the people who actually put it together, who mix the cookies, who sew the clothing, who assemble the bicycles. Their labor, the cost to pay them is a direct labor. And that's easily traceable in that we can literally watch them do it. We can see them make the product. Then we have a bunch of what we refer to as indirect costs that all get lumped into manufacturing overhead, or sometimes just overhead for short. And you've probably heard that term overhead because it's used to just throw around all the time. But for us, it is a manufacturing cost. So it's costs that are necessary to make the product, but that are not directly traceable to the product. Okay? So an indirect material, let's say we're building bicycles. The parts you can see and that are easily traced to include those wheels, handlebars, seat, all that kind of thing. But let's say you put grease on every one of the chains before you, in the process of putting it together. That's an indirect material because you probably can't see how much you actually use. It's a small amount on each individual bicycle. In total, it might be a lot of grease, but it's not something that you easily can trace to a particular one. There's not a formula here that says put this much grease on this bicycle, each bicycle. So that would be an indirect material. Nails in a house could be indirect. Anything you'd put into, if you're repairing cars, the part you're putting on the car would be the direct material. Indirect materials might include the rags to clean up, any of the fluids that you use to lubricate what you're working on, that sort of thing. those could all be indirect materials. And again, there's a judgment as to whether it's worth enough value to actually try to trace down. And computers allow us to trace costs that we couldn't in the past. So the idea of indirect materials and indirect labor is maybe a little more difficult to look at today. Indirect labor is the people that didn't directly mix the cookies, but who supervised the mixers, or cleaned up at the end of the day, or repaired the equipment that mixed the cookies. All of those could be indirect labor costs. And then you have all kinds of other factory costs, utilities and depreciation on machinery, and all of those kinds of indirect. You cannot say, I can see that bicycle used that much electricity. But you know in your mind that that's what happened, that the machine made the wheels or made the bicycle, or there had to be all these other, there had to be lights on so that the person could assemble it. That happened, you know that in your mind, but you can't say that bike utilized that much. So we're going to have to come up with, over the course of the next 7 weeks, some other ways of identifying how much of that indirect cost the bicycle used. And then we have what we refer to as non-manufacturing costs, or sometimes period costs. These are selling costs, advertising, cost of salespeople, general administrative, accounting, payroll, someone pays the bills, all of that, all of those costs are necessary. Otherwise, you won't get it, but they're not necessary to manufacture. They're necessary to support that, people don't come to work if you don't pay them, so you've got to have somebody in payroll. So there's a cost there. That's a general administrative. Again, there's not a rule about what is a non-manufacturing, what's a manufacturing. You use professional judgment as to how close, you might say, or how necessary it is for making the product. All right? Now, important difference is product and manufacturing costs are going to go into inventory, which means that they sometimes refer to as inventoriable cost, and then to cost of goods sold. Non-manufacturing costs or period costs are referred to as period costs because they go directly to the income statement. They never go to inventory on the balance sheet. So from an overall accounting standpoint, there is that difference in how they are treated. Once you've decided which ones are which, then they should be consistent about how you treat them. Now, we're going to look at the idea of manufacturing. In financial accounting, we focus only on what we call merchandise inventory that you buy and then turn around and sell. In managerial accounting, we're going to talk about manufacturing, which means we're going to take raw materials and convert it into something that's ready to sell. So we're going to have 3 types of inventory. We're going to start by ordering, buying, and storing raw materials. These are things that are necessary to make our product, but really on their own are not very useful. And then we're going to put them together, and depending on how long it takes, we're going to have what's called work in process, which can also be called work in progress, goods in process. Don't let the different terminology throw you off. It's all the same thing. Work in process, that means it's partially done. You've got a bicycle that's partially put together. You've got mixed cookies that aren't baked. Those would be work in process. And then once they're done and packaged and ready to sell, they're finished goods. So first you have raw materials, you buy that, goes into a storage room where you have that raw materials ready to use. As you need it, you transfer it or move that cost from raw materials into your manufacturing process. So they're in the works in process. It's partially done. Immediately upon putting it in that, it's partially done. And then when it's finished, think of that, it's then moved to a third location. It doesn't have to be a physical location, but think in your mind of that third location. That's where the things go that are finished and ready to sell. All of these are inventory. So when you see a financial statement, balance sheet for a manufacturing company, they'll often refer to it they won't say inventory, they'll say inventories, because they know that there's all three of these. Okay? These are all on the balance sheet, and they only include product costs, none of the period costs. They go directly to the income statements. So some formulas to help us calculate, help us track these costs. First of all, raw materials. We take what we had to start, beginning raw materials, we add all the stuff we bought during the whatever accounting period we're doing. That equals, those two together equals our available materials. This is a total pile that we could use. Some of those are indirect materials because often they are stored together. So we peel that off, and that goes to manufacturing overhead. So our indirect materials go to the overhead, literally an account for, keep track of another spot to keep track of the indirect materials in overhead. Direct materials are going to go in and start to be used in goods in process, right? In work in process to be put together in the manufacturing process. And then there's some that's left over. All right? Right? That you didn't use. You don't use all of it typically in any given month or accounting period. So our formula is beginning inventory plus the purchases minus the ending inventory minus what was actually indirect equals our direct materials used. Direct materials used. That's what was actually used to manufacture our product. So that's our, you might say, first formula or step in our process. So now we move to the second type of inventory. So we started, the first one was raw materials. This is our work in process. We start with what was in process at the beginning of the period, beginning work in process. We add in direct labor, overhead, and direct materials used from the last slide, the last formula. So we use what we ended up with in the last slide in this formula. Add those three manufacturing costs, then subtract out the ending work in process to get our cost of goods manufactured. All right, so you can't do this one until you've done the one to get direct materials used. Once you've done that, you've got this piece, you've got your cost of goods manufactured. That includes all the costs, the three costs, direct labor, materials, and overhead. Then we move to the third type of inventory. We're going to use what we got from the last slide. We're going to start with beginning finished goods. How many items we had done and ready to sell at the end of the last accounting period to start this accounting period. Then we're going to add in the cost of goods manufactured during this accounting period. So that was what we calculated last slide. Subtract out the ending finished goods and we get our cost of goods sold, which is a term we also use in financial accounting because that's what goes on the income statement. So in the manufacturing process, it takes 3 steps to get a cost of goods sold. Where if you were just bought the inventory and sell it, then it goes directly to cost of goods sold. You only have to do 1 step. So it's a 3-step process. All right. So, and if you make a mistake along the way, then obviously it's going to affect the calculations after that. And that's why it's important that we understand this and can work it all the way through. All right, so that's how we get to cost of goods sold on the income statement. So here's income statement that if you are taking 150 at the same time you're learning about right now as well. If you already took it, then you know what this looks like. But the income statement starts with sales, less our cost of goods sold that we just calculated in that last formula, equals gross profit. Then we subtract out the selling expenses, those period costs. Remember when we talked about manufacturing or product costs versus period costs? Those, when we pay those, they go directly onto this income statement. General administrative, also period costs, we subtract those. Typically anything to do with selling our products is a selling expense. Anything else, everything else falls into general administrative, and some companies don't even bother separating the two. They just list everything as selling, general, and administrative costs. And that's basically everything other than what it costs to actually manufacture your product. That equals our income before taxes, because for managerial accounting, we are not going to worry too much about taxes, because again, managers are making decisions based on how profitable. Taxes is dealt with is based on the tax law, and the tax accountants can work with it and stuff to figure that out. But we don't. That's not what drives how we just make decisions. We want to be as successful as we can at reaching our goals, and how much we pay or don't pay in taxes is really a very secondary issue in this cycle, if you will, in these decisions. So that will get you ready to work on homework, look at the questions at the end of the chapter, okay, and be able to answer those. You can go through, review some of the questions that are not, that are the end of the chapter exercises, and then you can do the check and make sure this all made sense to you. Work on the homework, and of course, once you've posted the homework, then you can your answers you can check and see, compare against my answers.